Good afternoon, everyone. This is Henry Gambell with SimplerOptions.com, and in tonight's free video, I wanted to start off with some of the ideas that we had shared in NFLX and continue to focus around a butterfly-centered theme. So when we did those videos right after NFLX had announced earnings previously, or a couple days ago, we were covering the idea that you could do the unbalanced fly for a credit, and as long as that credit is larger than the debit that you pay for the call side that you do on the other fly, well, it's another way of creating no upside risk. Okay, I paid about $1 for the long call side fly, and it didn't work, obviously, right, because NFLX exploded higher. So I was able to get out of that, and I got out of it for a 1-cent credit. So that credit, combined with what I took in here, left me with a profit overall in the trade of about $75 for each one lot that you deploy. So I always try to think in terms of risk first and being able to work around it, manage it in a way that you can still be profitable, and then of course if you've got this kind of volume, the strategies scale well. So that's one example of where you can use that unbalanced fly. Another place was here in Caterpillar, and this, I like to think it's the idea that you can see the way those strategies are used, and then when it comes up again, you've got them to use, and especially around earnings, these can be very helpful. So when we were looking at Caterpillar, the main logic here was saying I don't think it's going to go below 165, but I don't necessarily want to come out and just sell the 165 puts. We did this as the 170, 165, 160 unbalanced fly, and you can see with a close at 167, that's exactly where you want to be, because then all the premium that you sold here dissolves. And that's a big part of what makes the credit available, or the trade available at a credit, is that where you sold the multiple, the big chunk of it, that generates a very healthy credit that offsets what you pay on the other two contracts and gives you no upside risk. So when all of that is solidified, you see why, taking it in for a credit's a good way to get started. And then when it does trade a little bit more sideways and neutral, this is so much easier to manage, especially when it was trading down here, than if I just had the short 165 put. So if you can get all of those ways of thinking, now you can look at an example where I'm taking some heat, and you may still get a chance to put the trade on. So some news came out about WYNN today that was less than favorable, and I looked at the move and said, looking at it from a purely technical perspective, I think that the area from this swing low to this swing high, you want to measure the 618 retracement, and also notice how that is accompanied by the 21 EMA. So I'm looking at that zone thinking, okay, I think that's a point where we're due for a little bit of a bounce. I put the same strategy on here, taking in a credit, but then of course the problem is it continued to fall. So in those situations, you can either add more at a better credit, or one thing I did is put it on again with a shorter duration. So I do still need to see the pop. Also notice here moving it out to the shorter duration, but doing the body at a lower strike, because it's the same thing where by doing this, and if I have a miraculous and huge rebound, well then I still take in the credit, where a standard fly may have been done for a debit that would be lost. So you're giving yourself that no upside risk. If you trade sideways and volatility contracts, this can also be a profitable trade, and the only way I really get hurt is if WYNN falls all the way below 175 here and 170 here. So there's two examples from the past, one that is in the present and can be applied on Monday. I hope you find that helpful, and we'll see you at the next free video.